But also today is going to be the first in what is our brand new series, which is where we are going to be giving you direct access to some of the fund managers that we trust and we employ to make sure that your money grows. And so we trust them to shape and protect your clients well. So we'll be having Centaur on today, which I'm very, very excited for. In terms of an agenda, it's a short and sweet one from me. We're going to be doing a short little market and performance update. I'm going to try and break down what's happening globally and locally, as well as then just saying, okay, cool, what's happened to portfolio performance on the back of that as well. We then hand it over to Laing, who is from Centaur Asset Management. He's one of our key investment partners. He is the assistant portfolio manager and then also the global analyst at Centaur. He'll be taking us through some of the big picture view on AI, how it's kind of currently reshaping industries, and importantly, how Centaur is positioning portfolios to capture these opportunities for investors. And then, as always, we dedicated quite a significant amount of time to a Q&A session. So if you do have any questions that you'd like to ask Laing or myself, please pop it through into the Q&A chat at the bottom of your webinar, and we'll get onto those throughout today. So for those of you who've attended a Cinnabar Quarterly before, we normally do go through our shared purpose. And I think for those of you who haven't attended, this kind of paints a picture as to what it is that we're trying to do as a company and as a larger group. And so it's in our entire shared purpose to empower people to achieve financial freedom, because it is important for them to understand what it is that is important to them. And so financial freedom might be different from one person to the next, but the important thing is it's getting them into a position, and we try to do that through our investment offering so that they can start choosing what is important, whether that be family, whether that be travel. We're trying to help them navigate as investors or as advisors, navigate the complex investment landscape with confidence. So I think let's start with our bigger picture thinking. We're going to see what's been driving markets, but then also just trying to connect that to Cinnabar's fund performance. So we're going to start off by looking at the global backdrop, then our global fund performance before moving locally and looking at our local funds as well. But the whole goal for my section of this presentation is just to give you a clear view both on why markets have moved, but then also what does that mean for Cinnabar's funds on the back of that. So there's really been three major themes that have shaped markets at the moment. The first is we're seeing diverging economic growth across some of your major economies. As a result, and also a part of that, inflation appears to be under control in a lot of these economies, which is changing how central banks are starting to think about interest rates. And then third is we've seen the weakening of the dollar. And this has opened up some interesting opportunities for emerging markets like South Africa. And so we'll be going through each of these themes individually and touching on them a little bit. So let's start with the economic growth question. And I'm really focusing on three major economic regions here, the US, Europe, and then China as well, because there's three very different stories there. We have the US, where it has actually, despite a lot of the initial doubts, has continued its strong performance in terms of GDP growth. In Q2, it is on an annualized basis outperforming its long-term average there. So we're seeing is maintaining quite a robust nature about it. But then also a lot of the tech innovations, particularly in AI, are helping grow the economy further. But Laing will be touching on that a little bit later. And then as US is growing, there's a contrast. We look at Europe, where it's been a little bit sluggish. The uncertainty around the Ukraine and Russia war have hampered economic growth in the EU because of things like higher energy costs that they aren't able to get from Russia anymore, meaning that energy costs have soared a little bit there and slowed industrial output as a result of that. And so you might have seen start of the year, European stocks really rallied quite significantly, and there was a lot of optimism about it, but that's kind of settled down now and lost a bit of momentum. And then in a very similar vein, China's the same. They've also really been struggling to get going. They've been weighed down by a lot of weak domestic demand from Chinese consumers. very much struggling property sector. And then also a lot of the tariff-related export challenges have hampered their ability to sell out into the US market as well. And so all of them have kind of played a part in changing the global landscape. And so what this obviously means, or what this shows, is that it's no economy is necessarily falling off a cliff at the moment, but there is a clear divergence, and it's testament to why you need to have a very much diversified global equity portfolio. To be too overexposed to any region runs you the risk of experiencing quite significant downturns on that side. And so after 2 years where inflation has basically dominated every market update you probably listened to, we're now seeing a consistent cooling in most developed markets. Headline inflation is back to within target range for most of the developed nations. And what this has meant is that the central bank can start thinking about bringing down interest rates again. So as we can see by looking at the US here specifically, when interest rates picked up, inflation rates picked up, interest rates did to combat it. Eventually, interest rates stayed higher as we try to bring down level inflation. And now, as inflation starts to normalize, we've probably entered into more of a rate cutting cycle at the moment. With most likely that the US Federal Reserve will be cutting in September as well now for the first time, or again, it's priced in about 90% certainty there. So that's going to obviously help equities as a result of this because borrowing costs are going to come down. But also what this does is it continues a already weakening of the US dollar. The imminent rate cuts by the Fed has meant that the dollar has already weakened this year. The US dollar was incredibly strong throughout 2023 and 2024, but it's now softened. If we look at the dollar index, which is basically the dollar measured up against a basket of other major currencies, we see that this year alone, it's almost lost 10% in terms of its value. And we expect this to potentially continue into the near future with continued dollar weakness. But what this decline has done, driven by the rate cut expectations and then as well as improving global sentiment, it's starting to create a bit of a tailwind and a supportive push towards emerging markets, including the likes of South Africa, which makes EM assets more attractive to foreign investors. And so, as testament to this, we see how there's been, in the same way there's been divergence in terms of growth, we're seeing quite a significant outperformance from the emerging market index relative to the S&P 500, which are the largest 500 companies in the US. We see that it's an 8% outperformance of EM. And it's really reflective of two things. First thing is global investors are now starting to look outside of the developed markets into some of the emerging market regions because they offer some of the best global opportunities. But also that valuations are playing a massive part in where investors are looking at the moment. In general, developed markets are more expensive relative to their EM counterparts. And so moving to EM actually allows you to access more room for upside as money starts rotating back into these markets. And so for South Africa, this shift has been particularly important, not only because of what it means for the rand with all the inflows, but also how it shapes demand for our local market. But I'll come back to that in a couple of slides when I start talking about SA specifically. So we realized the emerging market was an area that we maybe were a little bit underweight, and we thought, okay, we need to bring in another emerging market manager. And so the big change in our global equity portfolio over the last quarter was bringing in a company by the name of Pacific Asset Management. And they have helped us capture some of this outperformance of emerging markets. And it's a position that we currently hold where we're looking at potentially increasing as well there, just to take advantage of some of the better growth outlooks in emerging markets. But what this has meant is quite consistent outperformance. And just looking over the quarter, both our global balance and our global equity funds have benefited from this emerging market exposure. The EM fund, there we go. The Pacific Asset Management portfolio, that fund has been brought into our global equity. And as a result, because it makes up a portion of the rest of our portfolios as well as a building block, we've seen that kind of push through performance into the rest of our portfolios. And so over a 3-month period, we've benefited in terms of our positioning And importantly, our global equity hit its 1 year anniversary and has also started outperforming peers over this period as well. So very happy with how that started. And so the process that we've been following over the past 5 years now is really starting to pay dividends. And slowly but surely, we're seeing the performance of our offshore portfolio here. I'm just looking at the global balance, really starting to materially outperform over a 3 year period. It's nearly 2% outperforming its peer group average. And so as we continue to reap the benefits of our consistency, we're going to see the 5 year number hopefully tick up above the long-term average. And so it's largely testament to our investment philosophy, by staying diversified, investing into quality companies, but then also selectively choosing how to invest into emerging markets as well. Moving across to the local side of things, there's some unique dynamics that are shaping opportunities for our local portfolios. The first being the rand strength, as we touched on, with a couple of cracks that are showing up there. The attractive bonds that is currently on offer from South Africa's government. They are quite attractive, but there's always an element of risk, as it is always with investing in South Africa. The Johannesburg Stock Exchange paradox, and I'll elaborate on that a little bit later. And then lastly, it is kind of the spotlight that's been shone on commodities, specifically gold, but then some of the other resources that South Africa is largely driven by. So we start by looking at the rand dollar exchange, and we touched on it earlier that the dollar has weakened by about 10%, and the rand dollar has only strengthened by about 7%. So it's obviously in a much better state than it was at the start of the year, but it remains one of the most volatile global currencies. And the reason for this high level of volatility is that the periods of strength in the rand don't come from something that happens internally, but it's more about global sentiment. When global sentiment and feeling towards emerging markets gets positive, the rand starts to strengthen as money flows in. But gains are often quickly reversed when local risks resurface. So we have an impact on the local risks impact our dollar, the rand dollar, but our local opportunities don't necessarily do as much. And so some of those local risks, you're going to be looking at fiscal policy, how the government manages its debt situation, Eskom and whether it keeps the lights on, and then some of the GNU working out is probably the main three risks there. And so one of the reasons the rand has had support at times is from foreign investors bringing money into South Africa. And that theme becomes even more clear when you look at why they're bringing money into the country. SA bonds have been one of the bright spots over the past couple of years and have been a large reason as to why a lot of our portfolios are outperforming. And we look at the 10-year government bond for South Africa, currently yields around 9.6%, which is one of the highest real yields in emerging markets. When you look at it on a real yield basis, that's at 7.1% there, so only slightly behind Brazil. And this is attracting a lot of foreign inflows as investors start chasing income in a low-rate global environment. But there are naturally risks that remain, with debt to GDP nearing over 75%. State-owned enterprises could also cap upside, and then markets, as a result, are going to be watching, can South Africa generate the growth that it needs to in order to bring down its debt ratio. And so this brings us on to the Johannesburg Stock Exchange paradox, which is just the South African equity market, where we also see these risks quite prevalent, where we only expected to grow by 1% in 2025. We have the second highest unemployment rates in the world. And then our government debt to GDP is sitting at 76.9% at the moment. Despite all of these kind of negative feelings, the JSE has rallied over 20% this year. It's reached all-time highs again, and it's continued to push over that 100,000 barrier at the moment. So there's quite a significant disconnect here. And it's largely the same reason I mentioned with the rand, where it's more about what happens overseas than actually what happens in South Africa. There is some internal reasons to why we're doing quite well, and that's largely down to valuations. We're quite cheap. Some of the domestic reforms that the government's starting to implement is slightly boosting investor confidence in certain regions. But the largest part that has driven the market so highly is global demand for commodities. And as a result, as global demand increases, commodity prices also surge, and that's boosted our JSE stock market to all-time high. So although everything's feeling a little bit uncertain, a little bit shaky, the market has still rallied on the back of that. And so gold, as we touched on, has been one of the star performers this quarter, this year actually. It's up 34%, and a lot of our fund managers that have access to gold are one of the top performers. And so that's up 34%. It's benefited from that weaker dollar we spoke about earlier, as well as it being a hedge, a little bit of a safe haven asset. When things get a bit uncertain, people just flock to gold because it's something that they can touch, something that's shiny and pretty, and something that they can hold. And so that's boosted up stock prices as well. But as well as central banks have been trying to steer away from the dollar, and have been adding to their gold reserves as a result of that. But for South African investors, why the gold has such a big impact on the JSE specifically is because a lot of the listed companies that we have on the Johannesburg Stock Exchange are rand hedges. So they earn in dollars, but report in rands. And so if the dollar goes and gets weaker, all of a sudden its rand earnings amount looks like it increases. And so this outsized earnings boosts the miners, boosts the companies on the stock exchange, and then therefore supports the JSE. But it's important to note that resources haven't necessarily all been equal. Platinum, for example, is up 53%, whereas steel is down 10% here. And a large reason as to why you're seeing this disparity is down to global demand, especially from the likes of China. So how it works is when China's economic growth slows down, or when its property sector comes under pressure, like it's done recently, demand for for commodities falls, and this hits resources companies' earnings directly. And that's why resources as a whole can offer a good driver for opportunity, but they're also a source of risk for the Johannesburg Stock Exchange as well. And so gold has played an important role in our portfolios this year as part of a hedge basis, but also in terms of a slight upside capture as well. And that's meant that the quarterly returns for our funds have been incredibly strong. We're looking at all of our local portfolios over a quarter period have outperformed, largely down to its commodities exposure. Some of the bond allocations in our more aggressive portfolios have also boosted performance there, as well as our equities being a little bit more of the rand hedge stocks at the moment. And similar to the narrative of the global balanced fund, the global equity fund, the long-term consistency is starting to be rewarded as well now. Over a 5-year period, I'm very happy to say we're outperforming peer group averages consistently as well here. But enough from the marketing spiel. It's more about looking ahead and kind of what's shaping markets for the rest of the year. And there's a couple of key risks and a couple of opportunities that we as Cinnabar are going to be spending the next 4 months balancing. On the risk side, we're really looking at the US election that's going to be taking place in November again. That could shake up trade and fiscal policies. We might see a little step back or a step forward in terms of tariffs. We'll be having a look at China's economic slowdown and what impact that has on South African markets, as well as other very resource-dependent economies. We're going to look at, is there significant steps being made towards South Africa's fiscal approach? Are they managing their debt to GDP ratio well, or is it something that's going to continuously kind of spiral up and up and up and up and just bring down our debt ratings into the future? And then lastly, it has to be market valuations. So we are conscious that markets appear very expensive in countries, especially like the US, and very attractive in emerging markets. And so that has to be one of the main considerations as to when we decide to allocate to any specific region or market. But there are obviously opportunities, and we are overall quite positive about economic growth for the country and the world as well. So we're seeing a lot of opportunity in SA bonds at the moment, like we touched on, with those real yields of over 71%. It's really something that's going to continue drawing inflows. As long as we can manage our debt to GDP ratio, we should be pretty comfortable there. We see further value in quality companies as well, the companies that have strong competitive advantages. Return on invested capital is quite high there as well. We see them continuing to outperform into the near future, and we're busy looking at bringing in another fund manager to complement that. There's always going to be the upside with resources as well. More of the diversification benefit right now, but as well as potentially a little bit of an upside capture as well. And then lastly, emerging markets as a whole. So I'm sure you've got that narrative that dollar's weakening. It looks like more capital flows will flow into emerging markets, and as a result, we've brought in fund managers that will hopefully reap the benefits out of that shift towards emerging markets out of developed markets. But these are all kind of short term for the most part influences. I think the reason we have today's session is because there's something that's truly transformative. AI specifically is going to be the biggest structural force that's going to reshape trillion-dollar industries. And so a key part as to Cinnabar's strengths and how we've managed to outperform, if we look at the returns, is by partnering with outstanding managers who bring deep expertise as well as very much differentiated perspectives. And so one of those is Centaur Asset Management. And today we're fortunate to have Laing on to talk to us. But before I hand over to him, I just want to quickly, for those of you who aren't aware, give you a bit of context as to Centaur's role in our portfolios. So Centaur is one of the key building blocks in all of our local portfolios. We have in some funds up to a 10% allocation towards Centaur, and they fulfill the flexible mandate, which gives them complete license to shift between equities to bonds to cash as freely as they would like. But they have got the proven track record as well as the team to be able to continuously do so. And so their flexible fund is the only flexible fund we invest into because of how confident we are in their approach. But Laing, at this point, I'd like to hand it over to you if you'd like to maybe introduce yourself, Centaur to the rest of the audience, and then maybe tell us a bit about your flexible fund as well that you help manage.
Yeah, absolutely. Can you hear me okay?
Yeah, coming through strong.
Okay, perfect. Yeah, good morning, everybody. So my name is Laing Walker. I'm responsible for managing the offshore components of the Centaur funds. And I've been kind of specializing in the offshore space of Centaur for the past 8 years. And really tell you, a little bit about us, maybe stepping back, we've been going for, nearly 25 years. We manage 12.5 billion rand. This is retail only money. And, we've really kept it quite simple. We've got, three funds, the equity balanced and flexible fund. And the reason why, the whole shop is kind of centered around the simplicity is that we maintain our focus, we maintain agility. There's not a lot of bureaucracy. We can really move fast as, facts change. And, we're really quite different in that we're very style agnostic. We'll invest in growth, values, cyclicals, turnaround, special situations. It just depends where we are in the market cycle. And, we pride ourselves on this kind of framework we have, which is this dynamic value creation framework, which is really these kind of, proprietary things that we look for in these businesses, in these stewards of our capital. And, with offshore, I think, just to maybe speak a bit more to that, I'm actually based this side. I've been living in England now. I'm in my 6th year. And we find that, it was a bit difficult to understand what was going on in offshore, being an SA. So having me here, being localized, always going to kind of different countries, meeting with new managers, with experts and people in the supply chain, with customers, you really form a much better mosaic of what's going on and in real time. And we think that gives us, an edge. We're also plugged into a large investor network this side. We're also part of something called the MI Global, which really, again, you've got your ear to the ground and you're kind of staying ahead of trends and disruptions and, being on the gravy train.
Mm.
And yeah, I think just last thing, with the flexible funds, it's been managed by Roger Williams for the past, 25 years. He's got a lot of skin in the game. He's a very different type of thinker. He's incredibly lateral minded, like immense mental flexibility.
Yeah.
Just a very good steward of your capital.
Yeah. No, 100%. Thanks for that intro. I think that your performance track record largely speaks for itself. Yeah, we see it relative to its benchmark, really strong outperformance there, as well as I see a little tagline there, #1 fund over 2 decades as well. So I'm sure that's a nice thing to write home about there.
Yeah, we're very proud.
Yeah. All right. So before we get into the discussion, thank you for being here today. I think you're the first of what is going to be one of our new series, and I think it's one of the most awesome ways to start. Starting with the fund that has been in our portfolios the longest so far. And so the reason we wanted to bring you today was I was in your quarterly update, and you spoke about AI, and I thought that
Yeah.
AI is often described as being this massive, like probably the biggest revolution in history. But what I got from your presentation is that no one fully understands kind of what its trajectory is going to be, how you start valuing it.
Right.
But what we do know is that you cannot just bury your head in the sand and just say, no, it's fine, I'll figure out later, or no, it's fine, well, it won't be that big. It's just like almost a fad. But what I realized was that as investors and then as advisors, it's important to learn to adapt and find ways to position for it. And so that's why to our audience, we view managers like Centaur as being quite critical. They're the ones who are helping us future-proof our portfolios, for lack of a better term, and are starting to begin this journey of quantifying the impact of AI in a disciplined but still being quite risk-aware way. So, Laing, with that said, I'm going to hand it over to you so you can unpack how you see this whole thing playing out.
I mean, probably the most important caveat is to understand is that I don't think anybody is an expert right now. I think we just have informed opinions. But yeah, sure. I mean, Cameron, if you can give me to that first slide, perfect. So I think these next slides are really about helping you kind of join us in this kind of think tank exercise. So we're trying to really conceptualize what this is going to look like big picture over the next few years, not just what's kind of in front of our nose. So everyone's trying to figure out how AI is going to look, how monetizable will it be, who's going to be disrupted, who's going to be a laggard, which industries will be affected. I think it's important to look back to history. So we've looked at historic, tech transitions. I think the most recent one, which would help us, would be, software. 10, 15 years ago, we all remember buying our Microsoft licenses, right? We'd pay a lot up front, a couple of £1,000, and we'd hang on to it for dear life until, we were eventually kind of forced to upgrade to the next one. And then the internet, kind of came along, cloud came along, and they could offer this, over the web. And it was cheaper for us. It was far greater access. The software guys made more money as well. It was very, transformative for everybody. It introduced this new business model, this, software as a service, SaaS. And what's interesting is we think with, particularly the advent of agentic AI, this will be turned on its head, and you'll have this new SaaS come into picture, which is this service as a software. And what we're talking about here, and again, it's largely oriented towards agentic AI. It's this idea that AI will start taking on human roles, and you'll convert, kind of human labor into software. So it becomes, more than an AI tool, it becomes a kind of digital co-worker. So, maybe to kind of give some examples, you go to a hospital and you'll be triaged by an AI bot as opposed to a nurse or a doctor. Or you'll, get on the phone, speak to a customer service rep, and it'll be an AI bot. And you probably won't even know the difference. And they might even resolve your problems, faster than a human would. And so really, we're going after a kind of, 1 billion knowledge workers. And if you put that together, you're looking at a $10 trillion TAM. This $10 trillion industry that it could slowly, chip away at and transform and make it more productive. Now, how this plays out and when, big question marks. Our view is over the next kind of 5 years, the lower tier rudimentary workers could be replaced. This view is actually kind of echoed and reinforced by Microsoft. They recently released some research saying that, they think that high AI applicability kind of spaces is, kind of even math and computation and coders and admin and sales staff. And so will be very, very disruptive, over the next 5 years, as I say, in this kind of pocket. But, beyond 5 years, the disruption, I mean, it should be enormous. But what we need to highlight is right now, even this opportunity is going to be big. If you look at how well the US stock market performed, just given the advent of the $1 trillion software market, we're talking about a $10 trillion industry that can be disrupted. So I think on this next slide, we're kind of going to segue into, how we're thinking about this maybe at more the industry level. So for this to work, you're going to be looking at spaces or industries where there's a lot of data. These models need to be trained. But I think, it's where labor is expensive. Maybe it's a bit redundant. Processes are very inefficient. Processes are very repetitive. So this will happen in a few ways, at least we think. So firstly, you'll have these companies that are ahead of the disruption and they'll self-disrupt. So, a good one here is Booking.com, which I think everybody knows well, probably uses it. We all use Booking.com ourselves. It's very efficient, but we still spend maybe a few hours, going through all the pricing and the options and putting the whole trip together and the hotel, the train, the car, the flight. They're, already kind of embedding agentic AI, where in the future, you're just going to say, Booking, book me a 2-week trip to Greece. This is the budget. These are the dates. You know what I like. You know how I like to travel. You know I like to sit on the plane. Just get it done for me. And it kind of, turns the kind of, human travel agent into a form of software. But in other industries, and this is maybe, the scary part, this is where the question marks are, there could be widespread disruption, particularly to the workforce. So you look at something like the legal industry, Harvey's going after this 1 trillion legal space where it's going after the whole paralegal role in general. And it could dramatically reduce lawyer case times. Something like software engineers, $1.2 trillion industry, AI factories going after it. AI can do coding. Not high tier, but low mid tier, it's there. And you've already seen a drop off in hiring in software engineers. And maybe it's not on the slide, but something we've noticed is even, SaaS, I talked about it earlier, the traditional SaaS industry been brought into question. Companies like Workday, ServiceNow, Salesforce, they've come into scrutiny because the market's trying to figure out if we still need these businesses, if agentic AI could do it faster and cheaper, and more efficiently. So it's very difficult trying to gauge, exactly where we are in this cycle. I mean, going back to Booking.com, there's an argument that even Booking could be disrupted. Even the guys that are trying to get ahead of the disruption could reach them faster than they can self-disrupt. So with Booking.com, agentic AI might, be able to, through APIs, plug into the hotel network, build at the supply side. It could aggregate demand on the customer end and disrupt both sides of the network. So, we just don't know. It's moving very, very quickly. And, obviously, big picture, these agentic applications will emerge across all sectors and it'll be wildly disruptive. But for now, we're 3 years into this revolution. And so it's difficult to predict the emerging winners and, who's going to be disruptive and whatnot. So I think in this next slide, I'm going to try and take you through our thinking about how this, might evolve from an adoption cycle perspective. So our research has shown that historically there's kind of 5 stages to kind of new technology being adopted. So you've got these first 2 stages where you've got the kind of early adopters, tech enthusiasts. They are very passionate about, the incoming technology, but there's no kind of, golden standard. The clear kind of leaders aren't in place. The use case is a bit unknown. The ROI is unknown. But once these things get figured out, you get the next 2 stages, which is this, mass adoption. The early majority, the late majority, everyone's forced to adopt. The standards are established, and it's working really well. And obviously, the last stage is kind of, the skeptics, the Luddites that they try to refrain from using it at all costs until eventually they're forced to. Now, you can see from this already, you'll probably be able to picture it yourself. We're in the early innings. We're only 3 years in, as I said before. Historically, we've seen it takes about 6 to 8 years for new technology to hit its stride. So this brings a lot of question marks. So a good example is Google. Obviously, I think it hit actually all-time highs last night after a favorable US ruling. But even Google, right now it's fine. Its search business is still growing. But if we look at the search business, which is its bread and butter, this chart here shows the growth in Google page views. It's a really good proxy for engagement with Google search. And you can see that that's turned negative. Since this launch of ChatGPT, kind of 2-3 years ago, Google page views has fallen. Now, everyone thought Google was the disruptor, that it's the ultimate disruptor, it's the gatekeeper to the internet, can't be disrupted. No, it's still fine today, but in a few years' time, that's where the question mark is. And so for now, we think, we're most comfortable looking at these historic tech cycles, and history, it doesn't repeat, but it does rhyme. Looking at that, we think that it's safest at this point in the cycle to back the kind of picks and shovels. Well, the guys supplying the picks and shovels. So for AI to progress, you need hardware. So we're invested in Dell. For AI to progress, we need cloud, and we need these LLMs. So we're in Microsoft and we're in Tencent. And maybe imagining to this is we're also in these AI kind of adopters that are kind of getting ahead of the disruption. They're self-disrupting at a rapid pace, something like Trip.com. So very similar to Booking.com. It's just, arguably the Chinese version. They've been embedding AI for years. They've been completely upgrading their customer service, moving into AI bots, and they've integrated it into the kind of personalization of it, the customer support angle. So you have to be very selective on who your winners are going to you have to be very selective on how you position, because as I say, our job right now is to understand, because things are moving so quickly, which of our current holdings could be disrupted and which of our future holdings could become disruptors and AI adopters, and also be on the lookout for advent of entirely new business models, because there'll be many businesses that are probably even unknown today that over the next 10 years could be the next $1 trillion businesses. So the key takeaway here is you have to be positioned for it, but there are risks. So on this next slide, let me take you through a bit of the hurdles we see as well. It's not all, sunshine and roses. So AI will be very transformative, but like every tech cycle we've seen historically, there are some bumps in the road, and it's not just, this linear progression. So a few of the key hurdles we see, everyone's talking about the demand side, but on the supply side, there isn't enough energy. There are grid and power constraints. AI is very energy intensive. It's about 10 to 100 times more energy intensive than a Google search. And this is even before we get to high level, high inference agentic AI. So we really need to see to the world's provision of energy to actually make, to prevent any kind of bottlenecks in the progress. There's a lot of technical restraints. I'm sure that a lot of you have seen that AI can still kind of hallucinate and come up with these erroneous facts. It's not always accurate. It obviously can't empathize. It has a lot of problems on its own, but it requires a lot of guardrails. You need a lot of supervision. And the irony there is, it's supposed to be kind of removing workers in some instance. You're actually adding workers because it needs to be supervised so much. There's a lot of regulator, not necessarily backlash, but there are regulator concerns. Right now you've got the New York Times suing OpenAI because, the argument is that these large language models, these AI models, have been scraping data illegally. And, if the regulator rules in New York Times' favor, you could see these AI models become, inefficient over the short term because they can't scrape as much data as they could before. There's also a lot of, regulations that could come through that could also kind of stifle progress. There's kind of adoption barriers. So it's obviously politically sensitive to adopt AI throughout a massive enterprise because obviously there is job loss. It's a very particularly politically sensitive kind of charged debate. Certain customers won't want robotic interaction. So I mentioned Booking.com earlier. We've already kind of seen surveys where the hoteliers are saying they don't want to deal with the bot, they want to deal with the human. So certain people just might not adopt. MIT released a study the other day saying that it was 95% of businesses aren't seeing a return on investment. And this ROI uncertainty was actually flagged by Sequoia last year as well. They mentioned a $600 billion revenue shortfall from all this CapEx spend. You put this all together, you've got Sam Altman talking about a potential bubble. You've got, NVIDIA missing for the first time in years since this whole frenzy began. You've got ChatGPT 5, which kind of underperformed expectations. All of this could lead to a near-term kind of supply glut where we've built up too much supply, it exceeds demand for a short period. We'd say this is more of a kind of, near-term, medium-term risk. There's that old, adage where, everyone says that we kind of overestimate the potential initially and we underestimate it over the long term. that is the kind of risk that we see, that things just get ahead of itself. Investors are emotional. We're human beings. We can kind of, get ahead of our skis. So these are the kind of hurdles. A lot of these will be resolved in time. That keyword is time. But zoom out, this is an enormous opportunity. And, for us, as we gain more certainty, you'll see our kind of exposure to the theme increase naturally. And, we're already positioning aggressively for it. Now it's just selective. It's selective largely according to risks, largely according to valuation, stewardship. So yeah, that's the end of my presentation. Cameron.
Right. Yeah, got a few questions coming through, and I think that's where we'll go next. I think you've done an awesome job at kind of painting how AI is moving from concept to reality, and how it's actually impacting investment markets. There's already a few questions that have come through, but there's actually a
Okay.
few that I wanna ask before we get started. So if you do have questions, pop them through there. It doesn't necessarily have to be AI related right now, but if you want to ask about that, we got one of the to be experts. Can't say you're an expert just yet, but to be experts here with us. There is one of the questions I wanted to ask you was actually, what are some of the early signs that the companies you're looking for long term have a competitive advantage? What are the inherent traits that show that they are using AI successfully, and that they're probably not going to be overtaken in the short term?
So obviously, the whole point of this is you need to embed AI so you can boost your revenue, boost your efficiency, widen your lead over your competitors. But I think obviously as investors, we have to actually be looking for non-obvious step changes in these operating metrics. So what I'm saying is that if it's obvious, it's already priced in, and it's priced in fast, particularly in such a hot narrative like AI. So you need to look for these non-obvious step changes. What I'm saying is I'm not talking about if Azure growth accelerates for Microsoft. I'm saying, take something like, software. If you see lower churn rates coming through due to AI, that'll lead to higher revenue retention, higher revenue growth. And it boosts the lifetime value of the customer. If you see faster delivery times and food delivery, that's going to be a boon for margins. So it's looking for these non-obvious step changes that I'd say can help you spot the kind of emerging winners and actually generate excess returns because it hasn't been picked up yet by the market. I think that's what we're trying to do quite avidly, quite actively. We're trying to just pick up on these kind of emerging signals. And then each industry, I'd say, will have its own unique operating metrics that you need to look out for. So as I said, with like food delivery, it'll be delivery speed. With software, it'll be churn. Yeah, I'd say that's the way we're doing it.
Yeah. No, I think that's so true. It's every industry is going to be specific, and so it's
Yeah,
obviously not easy to pick winners and losers, especially now this early on. We saw with
yeah,
the DeepSeek coming in and kind of disrupting the entire OpenAI market, making
yeah,
that share price sink on the back of it. It's recovered now, but we've seen that there's going to be these softwares and these companies that come out of left field that are really going to change the way the whole system operates. But maybe a question to
exactly.
you is, so you have this process, you find your stocks that you feel like are probably slightly more competitively advantaged, have a slight bigger competitive advantage.
Mhm.
Maybe as an end investor, how do they go about investing into AI without necessarily being like overexposed? Like you could obviously, if you think AI, you think Nvidia, or that's at least where my mind goes. How do you prevent necessarily becoming over concentrated in a couple?
Sorry, Cameron, you broke up at the end.
Where did I cut off?
So is your question, how do you avoid being overly concentrated in your AI exposure? Is that
Yeah, there
basically
we
it?
go. Yeah, yeah.
Right. I mean, there's many ways to skin a cat. I think how we would think this through. I don't think there's hard and fast rules, but there's always a kind of qualitative and quantitative approach to this. So I'd say qualitatively, uh, you could actually kind of use inversion. If you invert it, you just kind of say to yourself, and you'll know this intuitively, how will my portfolio perform if Nvidia starts to falter, if Microsoft or Google starts to falter? Um, and I think a big thing here is actually just understanding what your true AI exposure is first and foremost. So, for instance, you might be buying a utility company, for dividends, but actually, utility companies are directly tied to the AI theme.
Mm,
And you might be buying, a software business, maybe like, Salesforce, and you're thinking that, I'm buying this AI enabler, but actually, the market's view is it's on the verge of disruption. So you have to be very careful and actually ascertain what you think your AI exposure is first and foremost. Um, and then also understanding the true disruption risk that your AI holdings kind of face. I'd say it's kind of qualitative aspect.
mm,
Quantitatively, I mean, you could always check the benchmark. So, if your benchmark is the MSCI World, there's probably about a 20% allocation to AI in the MSCI world. For me offshore, that's kind of 80% my benchmark. So I would need to be at, my AI exposure would need to be 16% of the fund in order to kind of, be in sync with the markets. If I went overweight that, if I went to, 18, 20% plus, then obviously I'm starting to become, I'm taking a lot of active risk. And I'm starting to kind of, bet against the market, saying that, this is going to be a lot bigger, a lot more transformative now than you think so. So I think that, we aren't benchmark, cognizant in how we build everything bottom up, but it's still a good, indication to understand where you are versus what, the average investor's opinion is. It's a nice sense check.
yeah.
I think maybe one last thing is I'd also check because really the question is about downside risk. Um, so I check what your kind of valuations are for your AI exposure. So, some of your holdings are on lower ratings, they should fall less. And so, if there is a crack, you could actually have, a similar allocation to the benchmark. But if your holdings are lower valuation and there's less expectations embedded in them, then you'll actually see a lot of that kind of downside protection.
Mm,
So as I say, many ways to skin a cat, but those are some
yeah.
of the ways I would think about, limiting the downside, which, as I say, is really what the question is about, I would imagine.
Yeah. 100%. No, Peter actually put into the chat now, he said, actually very appropriately, there's two ways to invest into AI. One, invest directly into the AI hosters, so like the infrastructure, the backbone in bringing AI to life, and that includes like your data center operators, because we've got to understand that
Yeah,
that AI requires a significant amount of power, and
yeah,
yeah, might slow us down here in South Africa with our power struggles, but it requires a significant amount of power to actually build. And so these data centers need to be created. And so the companies that build that obviously could benefit. But then there is also largely what you've spoken about here is how are companies implementing and adopting AI, like the likes of banks, Salesforce, for example, where it's kind of taking over a large part of the operations. And I think it's probably the biggest realization I've had recently is that I think IQ, and I might get ahead of saying this, but I think IQ is going to come down in terms of the disparity. People who you don't need to be incredibly smart to be incredibly efficient at what you do. And so if you can start using AI in your day-to job, in your day-to-day basis, you are allowing your productivity to pick up an incredible amount. And so you need to start bringing that in because AI will come over and take over a lot of jobs. And so maybe a question I have to you, I've got my view is what kind of roles are probably better positioned? Like, what are the key skills, in your opinion, that you think AI can't necessarily replicate? Who's going to be the most valuable people in the company? Maybe let me ask like that.
I mean, I'd say it's quite obvious to say that, physical labor going to be difficult for AI to disrupt that until, maybe, we see the humanoids coming, but that's more of a kind of mid-2030s or later story, particularly at scale. So as I said, in our minds, it's the kind of, and I don't want to be rude to anyone's job here. I'm just trying to, categorize, you know, categorize all of this. The lower tier kind of rudimentary work is where we see the disruption coming. So I'm saying, it's like kind of your basic administration, it's your basic coding, it's your basic design work. Those things is where AI works best because again, there's a form of redundancy, there's a form of kind of inefficiency. It's that there's a lot of data involved. So it has to be a kind of knowledge worker oriented role, right? Someone sitting behind a desk, something that the AI can actually plug into, so it'll be around sort of computer access. And as I say, it's not high value critical decision making. We are years away from that, or at least from what we're currently seeing, things are moving so quickly. That is where the disruption will be. And if physical things, if you look at like I mentioned something like food delivery, AI can't hop on a scooter and go and deliver the pizza. It can't make the food either. But what it could potentially do is it could disrupt one part of the business, and that could be actually linking the riders to the restaurant, to the customers, and so disrupting that platform side of the business. So in terms of going from employees to industries, it's going to be very, very case specific. And I'd say that's the kind of
say you're not gonna get somebody to hop on a bike and deliver the pizza, but I've seen those Tesla taxis these days. I'm sure they can figure out something. Cool, Laing. Honestly, I appreciate you being here for us. There's a couple of questions that are maybe a little bit more Cinnabar focused. So I'll front those now. There are quite a few more questions. I don't think we're going to get a chance to go through everything. But one of the questions was asked here was we mentioned Pacific. Are there any other changes you're looking to make within the portfolios in the near future? So I touched on it. I didn't go too in depth. In our global equity fund, one of the big changes we're doing is looking at buying into those quality funds. So quality funds are slightly different. I'm sure a lot of you will be used to hearing about growth and value kind of stocks. Growth that they price in like this big growth potential, obviously, whereas your value is more like strong balance sheets. They are companies that don't have significant growth potential but are like steady, and so they obviously outperform in different periods. And so quality managers are one of the managers that kind of fit in between there. They shift between growth and they shift between value, but they really look for these companies that have got really strong competitive advantages, the likes of Microsoft or Apple, where they have a significant competitive advantage over a lot of their peers. These are the companies that in a downturn, they're not going to fall as much because they've got this strong balance sheet that helps them stay a little bit higher. So we're keeping quite a bit of exposure. We increased our exposure towards quality companies at the moment. And then locally, I think the biggest move we're making locally, obviously changing our income fund at the moment, but also I think on the back of some of the rand strength, we're going to be allocating a little bit more to EM even in our local portfolios at the moment. All right. Just having a look if there's anything else. Okay. Perfect. I think with 3 minutes left to go, there are a few more questions, so we'll respond to those individually. But I just want to thank everybody for coming today. It really has been an awesome session. I think we've seen AI has been, I mean, it's all we've really heard about recently. And so there's three main takeaways that I'd like to leave everyone with for the session. The first is going to be that there is going to be a lot of uncertainty and a lot of volatility going forward, but there are opportunities open up. So it's important to make sure that if you're not with Cinnabar or the other fund managers, that you are looking at diversifying your portfolio. That's almost always the answer to any investments question, is just making sure you're diversified. Secondly, AI is no longer hype. It's already transforming industry, so cannot just bury your head in the sand. You need to make sure you are trying to upskill and learn about how you can use AI to tenfold your productivity. And then thirdly, it's through partnerships that like Cinnabar has with managers like Centaur, that we are busy working to future-proof portfolios for this new environment where there is going to be a lot of change. And so I'd like to thank everyone for joining us today. Please do reach out if you'd like to continue the discussion one-on-one. But until next time, take care. Thank you so much and have a great rest of your Thursday.